Value investing in the modern portfolio theory offers two different ideologies and perspectives on investing. But which one is ideal for you? Keep watching till the end to find out. If you're someone who's studying finance as a major in college, or you've recently built your interest in investing in a better future. Either way, in both of these cases, I'm sure you might have come across the terms value investing and the modern portfolio theory, or MPT for short. Understanding the market is a crucial stage for every beginner, and turns out more often than others they realize this is not how they build wealth. Why? The answer is simply because a beginner in investing looks for tips and tries to follow the footsteps of their peers without being fully aware of the situation. Little do they know, they've already turned their capital behind these tips and strategies for which they worked day and night and skipped dozens of parties, which is why we have made these videos. So you don't have to ask for biased opinions of fake stock market gurus and experts. Let's start with the great debate. What is value investing? For a second, let's assume you might have correctly guessed from the term value investing as investing in assets like stocks, mutual funds, real estate, or even cryptocurrency, whichever you find suitable, but it should represent value. And value by definition is something that presents usefulness, deserves importance, and serves a purpose. Let's understand the concept of value investing with an example. 5 to 10 years age from now, no one believed in electric vehicles and environment-friendly transport. Mercedes, BMW, and Toyota were ruling the streets. But now, things have taken a huge turn as we begin to notice a global tilt towards high-demand electric vehicles. So, the concept of value changes with time. There's also a car Swedish manufacturer called Volvo, which has been around since 1927 and makes one of the safest and durable cars on the planet. But still, investors and consumers will find a reason to believe in Tesla, as they are currently the hot topic in the automobile industry. Moral of the story: value in terms of investing is highly driven by the demand and supply curves of the economy, which is again highly subjective to change through 5 to 10 periods of time. Overall, value investing can be a useful strategy for long-term investors who are willing to be patient and are comfortable with the potential for short-term underperformance. How to look for value stocks? Now, before we move on to that, if you're liking this video so far, drop a like and press the subscribe button for more of such amazing content. Determining value-oriented stocks can be a challenging and time-consuming task, which is why I've personally spent my time researching and tailored a few set of rules to help you guys pick undervalued stocks. Rule number 1: shortlist companies with growth potential. Warren Buffett is a well-known investor and the CEO of Berkshire Hathaway. He believes buy into a company because you want to own it, not because you want the stock to go up. In other words, he emphasizes the importance of looking at the long-term prospects and fundamental value of a company, rather than just trying to make a quick profit based on short-term market movements. Another quote of him goes like, if you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. This advice reflects Buffett's belief that value investing is a long-term strategy. It is not about trying to make quick profits by buying and selling stocks based on short-term market movements. Instead, it is about finding good companies with strong fundamentals and holding on to them for the long haul. Talking about strong fundamentals. Here's rule number 2: sort aside companies with strong financials. By reviewing a company's financial statements, you can get a sense of its financial condition and determine if it is in a strong or weak financial position. This can help you decide whether or not to invest in the company or do business with it. Here are a few things which you might want to look out for while considering rule number 2. Number 1: high profitability. A company that is consistently profitable over time is generally considered to have strong financials. Profitability can be measured by various financial ratios, such as the net profit margin, which is calculated by dividing net income by revenue. Number 2: strong balance sheet. A company with a strong balance sheet will have a healthy ratio of assets to liabilities. This means that it has enough assets to cover its debts and other financial obligations. The debt-to-equity ratio is one measure of a company's balance sheet strength, which compares total liabilities to total equity. Number 3: good cash flow. A company with good cash flow is able to generate enough cash to meet its operating expenses and fund its growth. Positive cash flow is important for a company's financial stability and ability to pay dividends to shareholders. Let's move on to rule number 3: credibility of the leadership. The management of a company can have a significant impact on its stock price. Investors often consider the quality of a company's management when deciding whether or not to buy its stock. A company with strong management is typically viewed as having a competitive advantage over its peers, as the management team is responsible for setting the strategic direction of the company, allocating resources, and making key decisions that can impact the company's financial performance. On the other hand, a company with weak or ineffective management may struggle to execute its business strategy, leading to underperformance and potentially a lower stock price. So, choose wisely. Value investing is generally a long-term strategy of investing. It requires time and efforts to cherry-pick stocks that are falling under its category. But on the same time, the odds of hitting the bullseye and bagging hefty profits are more easy to pull off while value investing. Now let's hear what the Modren portfolio theory has to say. MPT, or the Modren portfolio theory, is a financial theory that explains how investors can maximize their expected return on investment while minimizing risk. The theory was developed by Harry Markowitz, a Nobel laureate in economics in the 1950s. The MPT suggests that investors can create a diversified portfolio of assets that will provide the highest expected return for a given level of risk or the lowest level of risk for a given expected return. The theory is based on the idea that by combining assets with low correlations, an investor can create a portfolio that has a lower level of risk than any of the individual assets in the portfolio. What's the real application behind the Modren portfolio theory? The MPT suggests that by combining assets with low correlations, investors can create a portfolio that has a lower level of risk than any of the individual assets in the portfolio. This is because assets with low correlations tend to move independently of one another, so the overall risk of the portfolio is reduced. In other words, the MPT is based on the idea that diversification can be an effective way to manage risk. But according to Mr. Warren Buffett, diversification is a protection against ignorance. It makes little sense if you know what you are doing. This quote suggests that diversification can be a useful strategy for investors who are unsure of which specific investments to make. Buffett, who is known for his successful investments in a small number of companies, has famously argued that a focused investment approach can be more effective than a diversified one for investors who are able to identify high-quality stocks. You see, the Modren portfolio theory can show its true colors only if you find yourself managing funds worth millions or even billions of dollars like most hedge fund managers and big investors of the game. Otherwise, if you're barely starting your investing journey with a few thousand rupees, only then I believe that you should not be worried about balancing your portfolio with low-risk assets. That being said, let's move ahead and do a more heads-up comparison of the cons of the Modren portfolio theory. While MPT is a useful tool for investors and financial advisors, it is important to be aware of its limitations and to consider other factors in addition to risk and return when making investment decisions. Number 1. Assume markets are efficient. MPT is based on the assumption that financial markets are efficient, meaning that all relevant information is reflected in asset prices. Number 2. Ignores behavioral biases. MPT does not take into account behavioral biases, such as overconfidence or loss aversion, which can influence investor decision-making. This can lead to suboptimal portfolio construction and performance. Number 3. Focuses on short-lived growth. MPT seeks to maximize expected return for a given level of risk. This can lead to a focus on short-term performance and a neglect of other important factors such as dividends, earnings growth, and company fundamentals. Number 4. Complexity. MPT can be a complex and mathematical theory, which may be challenging for some investors to understand and apply in practice. This brings us to the end of the video. To summarize, what do we know? What have we learned? Value investing is a good way to build and conserve wealth. Investors are usually ready to pay a premium to staying invested in such opportunities. While on the other hand, the Modren portfolio can also be a great way to go, but under certain underlying circumstances. Now, before you think of moving out, do not forget to reach out in the comment section to type your preferences: value investing or the Modren portfolio theory. Please hit the like button if you didn't and subscribe to the channel for more such content. Also, let us know, do you want to know more about how money works and want to maximize your investment returns by visiting our video on the book Psychology of Money by Morgan Housel. Till then, see you next time. Omega Finance signing out.